Hey, welcome back to Everything Money. We're glad you joined us again. As always, it is Seth, Paul, and Mo. Well, not as always, Paul. I mean, that's an exaggeration. Sometimes it's just a couple of us. But we are here, and what you're going to learn in this video is the following. We're going to take a look at Apple. This puppy's coming down right into Mo's sweet spot, I would say, Mo. Very requested on the morning show, the 9 a.m. live stream in terms of trading. Paul, you love this stock at a much lower price. We all love the Apple products. As you know, Mo has 17 iPads. I'm getting the new phone, Paul. Finally.
Are you?
I'm getting off the 8.
What are you going to get? The 13?
13.
Pro
All
Max.
the commercials say I can just be a cinematographer. So
there you go.
Hey, we'll do that. But we're going to talk about the financials of Apple today. Look at the numbers. What the hell is going on, especially with the stock price? The whole market's down. And we're going to update this. And maybe it's moving into a buy for Paul, or at least some sexy puts he might be putting out there. In the meantime, I introduce Paul Gabriel, the seer of seers. Go ahead, Paul.
All right, so Apple...
Follow us on Instagram, of course, Paul.
Oh, yeah, follow us on Instagram. Really helps us
today.
out. So Apple is incredible because one of the big... I'm going to skip to our second pillar, return on invested capital being greater than 9%. What this return on invested capital is, how well do they make money on the money invested in the business? Look at this number. We want it over 9%.
Yikes.
They're at 30% over a 5-year period. Now, that's a check. But we go to their 5-year PE, 38.1. So that's an X. We want it less than 22.5. Several years ago, maybe 6 or 7 years ago, a big Apple fanboy asked me once, Paul, what do you think of Apple as a value play? Guys, go back and look at their financials from 2015. It was incredible. They were selling for like 10 or 12 times earnings. And all I said to them was, this is a definite value play if you believe that the growth is sustainable.
Was it?
So let's look. I didn't think so. This is why you should ignore Uncle Paul sometimes. This was in 2015 I said this. They had $224 billion in revenue. Now they're doing 347.
Ain't nobody got time for that.
So they clearly kept growing all along the way. And so from the 5-year perspective, I looked right for a couple of years, 224, 220, 223, but now it's really shot up. So it's a check mark there, okay? Now, I like revenue growth. I don't care how fast it is. What I care more about is, are they able to figure out better ways to make more money? To generate, especially a company this big, it's going to be very hard for them to grow at high rates of return. Just grow in general.
If you're staying this long, hold on to the end of the video. Mo is going to go over the trading. If you want to trade this at a quicker pace in the Bid and Ask Nation, our community, we'll head over to Mo to see what's going on with the charts. Paul, keep going with Apple's financials.
Now, the next pillar is our net income growth. We want to see a 5-year net income growth, 46.6 to 87 billion.
Lord.
Now, one thing though, Seth, look at this. The previous year they did 58 billion. So big jump, probably COVID related. People were home. They had to invest in iPads. The kids are home. We have to do Zoom, things like that. So my personal opinion is I would not put too much value on the last year's results. I would discount last year's results a little bit more, okay? Shares outstanding. Now this is going to be big. Guys, look at this. They had 21 billion shares outstanding. Now they're down to 16.6.
Jeez.
Now, I will say this, Seth. One thing we don't like, we don't want it when companies are buying back overpriced shares.
That's true. Tell me why.
Well, basically, they're investing their money in an overpriced asset. It's no different them investing themselves versus buying another company's stock, right? So if they were selling for 7 times earnings, they're investing back in their company at a very low PE. But this is, the last 5 years are at 36 PE. The last year they're at 27. So they're kind of paying a little high amount for it, but
I see. So you're sort of saying is they're overpaying for themselves at the moment.
Correct. Right? And their dividend, I think Apple does have a dividend, which I didn't cover.
Very small.
Very small, 0.6%. But isn't it funny?
Only
They're
14 billion.
Yeah, it's $14 billion.
Massive amount of money.
So somebody might argue, well, they're saving that dividend. It's like, yeah, but I'd rather have them pay down debt. Because they have debt, I guarantee their debt is higher than 0.6%, right? So I'd rather have them pay down that debt than buy back shares to save a measly dividend. Now, if their dividend was 6.6%, I would say, yeah, buy that dividend back. You're going to save yourself 6.6% on every dollar you invest there. So these are the things to look at. Now,
the GDP of El Salvador last year was 24 billion, Paul.
So Apple is currently 15 times bigger than El Salvador, the country that has approved Bitcoin.
Yeah, that's why it's so revolutionary.
They're going to be 25 trillion soon here, right?
So keep going, Paul.
Now, guys, this software we have here, I created because the users who are watching us said, how do I get your software? How do I get your data? So I created it, and it's very simple. We give you a mobile app. We give you all 8 pillars. We give you 30 years of financial data, stock analyzer tool, which you'll see at the end of this video, daily content. Every single day you're getting content only for people who buy the software. But biggest thing here, we have over 6,300 people who have access to our Discord community where you can go meet other people who are talking about investing, any sort of topic you want, crypto. Guys, all of this for only 87 cents per day. If you are serious about money and investing, this will pay itself over hundreds of times over in your retirement. You get all of this while our competitors are $200 a month, $200 a month, and $35 a month. Sign up at the link below. Go to everythingmoney.com or join our Patreon if you prefer that. But the bottom line is, guys, this is great. And now we're going to go to...
Pillar number 6 is total long-term liabilities divided by 5-year free cash flow. Paul, we want this under 5.
Yeah, so what we do here is, guys, I go to the main page. I look at our 5-year average free cash flow. So in the last 5 years, they've averaged $67.5 billion a year in free cash flow. I want their total long-term liabilities to be less than 5 times this amount. So basically, their total cash flow over the last 5 years, I want it to be greater than their total liabilities. So 67.5 times 5.
340.
How much?
340.
So I want their total long-term liabilities to be under 340 billion. So what do? I go to our trustee balance sheet.
Please do.
I scroll all the way to the bottom. Total long-term liabilities, less than half that.
Wow.
So that's a major check. So that means in less than 2.5 years, if they mimic the last 5 years free cash flow, 2.5 years from now, less than that, they could pay off all their long-term liabilities.
Why is this important, especially during a correction that might be coming?
Well, it's not correction. It's more of a economic thing. If the U.S. economy enters a recession, what is more likely to happen? A company with a lot of debt going under or a company with little debt going under? I think it's pretty obvious, right? We can all agree that if you have more debt, you're more likely to go under. Now, that doesn't mean that if Apple can pay off their debts in 2.5 years and another company is 3, this one's headed for bankruptcy. Mm-hmm. No, but it's just more of a reference point of saying, hey, they do a good job of generating cash flow and keeping lower amounts of debt. They're more likely to stick around. If you and your neighbor have the exact same job, everything's the same except they have $10 million in debt and you have 0 debt, who's more likely to go bankrupt?
Mm-hmm.
It's very obvious. That's the way I look at this thing. And it's not just to say, oh, low debt, let's buy them. No, it's more to say, okay, companies that stick around are more likely to give you more return, right? Because we've learned that when it comes to investing, being in the game for long periods of time is way more important than even picking the exact best stocks every single year. Stick in the game.
If you clicked on this video because your friend told you to be interested in Apple, or you've just bought a ticker symbol and hoped it went up, this might be news to you. This is one of the most important pillars we have is pillar number 7, which is free cash flow. Paul, you want a company generating free cash flow, which leads to really the health of the company, right?
Correct. And free cash flow, guys, is cash from operations less your capital expenditures. Uncle Seth, tell them the 4 things they can do with their free cash flow.
When they have a massive amount of free cash flow, they can buy back shares.
Yep.
They can make acquisitions, which I don't know why they don't buy more companies, Paul. They got so much damn money. And let's see, buy back shares, make acquisitions, and pay down debt. Pay down debt. What's the
what
fourth
else?
one?
Pay dividends.
Oh, pay dividends, of course.
Right?
Wow.
So why don't they make more acquisitions? I'm actually glad they don't make too many acquisitions because companies, when they tend to make acquisitions, tend to do a pretty bad job of it. I'd rather them give the money back to us shareholders by buying back shares or paying down debt. So anyhow, we look at the 5-year and we add this line to our software. No other financial statement has this line. We add it ourselves to make it easy for you. 53.2 billion to 95 billion. Check mark there with an average of 67.5. So our 8th pillar, we take our average free cash over the last 5 years. We multiply it by 20. That's kind of like our, hey, this is what we want to pay for the company, kind of in general, and this is $1.35 trillion.
Yep, that's right.
And the current market cap is 2.3 trillion. So it's an X here. Okay. Now does that mean Apple's not a buy? No, because if I told you Apple's revenue was going to double in the next year, you'd pay that all day long.
What do you think it's going to be doing the next 7?
So we will look at that really quick. For those of you who don't know the software, the 8 pillars tab just tells you all the 8 pillars we just went through. And guess what? The 2 X's are what?
Valuation.
So this just tells me, okay, it's probably overvalued, but what we're going to do after Mo is done is I'm going to show you our stock analyzer tool where I'm going to put assumptions for the next 7 years in Apple. Because I do believe Apple will be around for 7 years. I happen to pick 7 years. Some people pick 5, some people pick 10, whatever it is. I'm going to look at 7 years on Apple. I'm going to make assumptions on their growth rates. And then we're going to see if it's a reasonable buy or not.
Folks, this is a value investing channel. We're buying undervalued stocks and holding them for a long time. If you're interested in trading Apple at a quicker pace, you can head over to the Bid and Ask Nation in our Everything Money community and join Mo on a daily basis. Mo, this is so requested by your followers in the morning. Yep. Apple. You said you bought Apple. This morning you said it's one of your someone asked what's one of your go-to stocks.
My go-to stocks.
Yeah.
I mean, they say my favorite stocks out there. It's Apple. I mean, look
but your entry point, Mo, is a lot different from today.
Correct. I bought it in 2015 around $27. What would be $27 a share after the couple of splits that they've had. So for me, I'm not buying Apple now. I want to buy Apple again when it pulls back, but my cost basis is way lower than probably any of yours. But let's look at it from this.
Cocky.
What?
Cocky. I love it.
Oh, damn right. This is a part of the Employed Trader series. We caught this run up, and it was very good. This is what I like about Apple. It can go for very long runs on trend, and then it can go sideways for a very long time. Now, we caught this. We lost in here. This is when all that volatility in the market started. We did get that pullback, and you know what? It's part of trading. It is what it is. I'm not concerned about it because, once again, if we see Apple's very difficult to short because, as we saw this morning in one of the stories I read, this is responsible for the FANG stocks, which Apple is one of. It was responsible for half of the pullback yesterday in the market when it was down 400 points or whatever it is. So it's very, very polarizing. It's hard to short, but I'm waiting for this thing to come down here and we can grab it and swoop it back up again when it runs back up to the top. Now, the bad thing going on for Apple from a trading perspective, it is dipping right below that 100-day moving average, right here, Seth.
Mm-hmm,
so right now it's below the 100, so that's a very bad sign for them. If they get below the 200, look out, because I think this thing will go towards the 100s, which is it's possible, it's fine. Company and stock price are different, like we always say, but if we can generate a short off of this, it's probably going to be under the 200-day moving average.
Paul, what should we be paying for Apple using some assumptions moving forward? This is everything, right? What are we going to think Apple's going to do in the future? Where can the stock price go?
Okay, so every investment is based on assumptions. Every investment is the present value of all future cash flows. So how do you determine cash flows for a company? What I like to do with our stock analyzer tool, I like to make revenue assumptions, share buyback assumptions, profit margin, free cash flow margin, and then multiples of each. And I do this, and these are the assumptions I'm making. It's going to pop up on your screen. Take a look at it. Pause the video if you want to take a look. But basically, I'm assuming lower growth rates because it's such a big company, and they had such a big jump last year. We don't have it right now where I can sit there and do an initial 1-year drop and then grow from there. But either way, I made these assumptions. I very simply hit the Analyze tool. For my desired rate of return of 15, 12.5, and 10, the prices I need to pay are around 60, around 90, and around 135. Okay? I like to concentrate in this area. So I'm looking at going, if I want to make a 12.5% return on my conservative assumptions, I have to pay around $90 a share. Now, this is based on 6% a year in revenue growth. If you say to me, Paul, that's ridiculous. They're going to do 8 to 12% low to high range. Well, it changes things a bit. Now, all of a sudden, my price all day long in the high range is there. If you think they're going to grow 12% revenue in a year for the next 7 years, buy it all day here. But if you think it's going to grow 10% a year in revenue, it's not far off. We're at 140, it needs to go down to 110 or so. So that's the point of the stock analyzer tool. It's not to say, go do this right now. It's more to say, hey, what do these assumptions look like? Get a feel, is the company overpriced or not? What I like to do is, for a company like Apple, our software is going to allow you to put this on a watch list and give you an alert. I would probably set an alert for myself around 120. It's at 140 now. If it drops to 120, I'll start taking a better look at it so I can do what Seth said, sell some puts, which you can see other videos on that allows me to buy the stock at the price I want at a date in the future. Now with Apple and how big it is, the puts are going to generate me very little income, but that's not the point. The point is I can be paid to wait for the stock to go to where I want it to go. But I'm probably going to start paying more attention to Apple around 120 a share or below.
Yeah, I think Apple has a really bright future ahead. I mean, they have not even started to get into being a service industry yet. I mean, they're barely in there, but I think they have a lot of room to grow.
But we're all immersed in them. So if
that's
anybody's
the thing. They have
able to,
2 billion devices in people's hands.
Is that what it is?
Yeah. So
2 billion.
Is it that many? Geez.
Yeah.
And and what percentage of the world doesn't even have access to Apple products?
Exactly. And the way that they integrate Apple TV, Apple Music, Apple Fitness, everything, I think they're just getting started.
I had Roku for a long time, and finally I was just like, what am I doing? I'm just gonna get on my Apple TV, and now I have Apple TV and I love it. The Roku is great. We've talked about this, but I like the Apple TV way more.
And you know what's funny now? I use Roku. I don't use Apple TV anymore because Roku integrates Apple TV.
Oh, really?
Yeah. So now they're spreading to they're doing something different that they've never really done before. They're spreading to other devices with their Apple TV product.
You don't want to be bothered by the watch. My wife loves this watch. She tracks
I'm a watch
everything.
guy. I'm not.
You're right. You can't wear a little
You're
machine.
talking, yeah, to me, but if I wasn't a watch person, I would
right.
definitely wear an Apple Watch.
Yeah.
She loves it.
And I love seeing, I'll see athletes, making $20 million a year and they're wearing an Apple Watch. Now, granted, I'm sure they're doing it because they're trying to keep track of their. So when I do cardio, I make sure I have my phone in my pocket so it keeps track of my steps.
Oh, okay.
But if I have a Zoom call, I have to hold it because if I put it on the treadmill,
Yeah, you don't get the steps.
I won't get the steps in, right? And Tim and I do treadmill twice a week, and he'll usually, I don't know if he pays attention, I have the thing in my pocket because I want to keep track of my steps.
You should get an Apple Watch just for when you're on the treadmill or working out.
That's a good idea.
That is a good
Actually,
idea.
I'm going to order an Apple Watch right
I'm
now.
so full of good ideas. I don't even know.
Boy, Mo, look at you go.
I think I just have to go now.
How do I see if I was so stupid that I didn't even think about that?
Just put it on the treadmill in there in the workout facility.
Apple Watch. Which one should I get, Mo?
I would get Series 7. It just came out.
Wait, can I buy it on Amazon or no?
You can go to apple.com.
I
For
need
all
to
of
do
your
that for the
Apple
phone.
needs.
What was that?
I need to get the new phone. I tried to pre-order. I got to go to AT&T, all the malarkey, but I'm getting that thing. I love it. All right, that's our show, folks. Sorry to bore you with our buying purchases, but these things, just it used to be drink the Kool-Aid.
Yeah.
And now it's like, Jesus, I cannot live without my phones,
really
my
hard not
iPads,
to.
my iMacs. I love it. I love
How's this
what
one?
they
Is
do.
this too feminine?
No,
Seth,
it's very
you know what's
sexy.
interesting?
You're a feminine guy.
Is this too feminine?
I mean,
you
look like you're about to go play football in Portugal. But
Great,
yes.
then I'm going to buy it. Buy now. It's going to come tomorrow. There you go.
There you go.
Thank you, Amazon.
Beautiful. What were you going to say, Mo?
You know what's interesting because we talked about Apple Car before.
Yes.
Foxconn went in and they're doing the Lordstown deal. Foxconn's really big into making iPhones.
Come on.
I've said several months ago, if Apple does anything with a car, I do not think they're going to do a startup. They're going to go and buy a company that was already in existence.
How
and try to
incredible would it
integrate
be
it
if
that
we
way.
had Apple building cars
Right
40
here.
minutes away?
Yeah, but I think because Foxconn moved in there, I think that's their long-term play at cars.
Exciting
Remember where you
stuff.
heard it first.
You heard it first here.
I heard from Steve Jobs.
Fondle that thumbs
Too
up.
soon.
Fondle the thumbs up. We'll see you in the Discord chat. Love you guys. See you.